Michael Burry, the famous investor from The Big Short, just bought a brand new stock that I had never heard about before. And when I started researching it, there are people saying this stock could go up 500% or more over the next 2 to 3 years. Imagine buying Tesla at $12 before it ran up to over $400. Or Nvidia at $11 before it ran up to over $130. Or imagine you could go back in history and buy Hims at $4 per share before it ran up to over $60 per share. That is the opportunity that you have right now, because the stock that Michael Burry bought has the potential to see an exponential increase in stock price over the next 2 to 3 years. When Michael Burry released his portfolio for the end of the year, he revealed that he had put 3.5% of his portfolio into a stock called OSCR Health, ticker OSCR, and he's already up 10% on his investment. Now, I'm not one to get super excited around hype, but when I started researching the stock, I found out that they were a profitable company that are a value stock right now, and I saw that the potential for this stock to increase exponentially is absolutely there. Although I will warn you, there are some risks. So in this video, I'm going to show you what I learned about OSCR Health. I'll show you how they are leading the healthcare industry with a brand new technology that's never been seen before, and how they are a leader in this technology and AI space when it comes to the healthcare industry. I'm going to show you the fundamental analysis and show you how they became profitable and where they could go next. We'll also go over the technical analysis and decide whether now would be a good time to buy or whether you might want to wait. And we also have to cover the risks and some of the downside potential for this stock as well. In full disclosure, I do not own any shares of this company, but I am thinking about buying some shares shortly. For those of you who are new to this channel, my name is Stock Curry. I'm a former Merrill Lynch and Morgan Stanley investment banker, and I have over 25 years of trading experience. OSCR Health is a health insurance company that is using AI and technology to make healthcare affordable. OSCR Health is an American health insurance company headquartered in New York City. They focus on the health insurance industry through telemedicine, healthcare-focused technology interfaces, and transparent claims pricing systems, which make it easier for patients to navigate. And I've got to tell you, when I read the word telemedicine, I got concerned. Because the last time retail jumped into a telemedicine stock, it didn't turn out so well. Teladoc, ticker TDOC, remember this one from 2021? Yeah, well, it fell from highs of over $300 per share all the way down to $11 per share. So investors need to understand that investing in a company like OSCR Health does not come without some downside risk. Yes, the upside potential is massive, but you better put a stop loss in place just in case the stock falls. Now let's get into why this company is a leader in the healthcare industry and how they're using technology and AI to lower the cost of health insurance. From OSCR Health's website, they say they are a leading healthcare technology company built around a full-stack technology platform and a relentless focus on serving their members. They have been challenging the status quo in the healthcare system since their founding in 2012, and they are dedicated to making a healthier life accessible and affordable for all. As of the end of last year, they had 1.7 million members. They did $9.2 billion in revenue, and they were operating in 18 states. And this alone should show you how they have huge growth potential. The fact that they're only operating in 18 states means they're not even operating in half of the states in the US. And once they expand to the rest of the United States, their growth in both revenue and profits could explode. And that's where we have the potential to see this exponential increase in the stock price. Oscar Health's mission is to make a healthier life accessible and affordable for all. They do that by harnessing their technology in order to empower others. They are using their technology not only internally, but also externally with other health insurance providers. 80% of health plans outsource a portion of their core operations, and Oscar Health takes over those core operations with technology and IT services, providing a tremendous amount of savings to these other healthcare companies. And the benefits for both employers and employees is massive. Employers get a defined contribution amount rather than an annual increase in premiums, and this saves employers a lot of money. Setup is also incredibly easy. A traditional healthcare plan takes over 30 hours to set up, but with Oscar Health, it's done in less than 10 minutes, meaning small businesses can now provide health insurance to their employers without any hassle. And the benefits to employees is equally impressive. Rather than having 3 plans to choose from, like you do on traditional health insurance, where you might have an HSA, an FSA, and a high deductible, with Oscar, you get your choice from hundreds of different plans. In addition, rather than seeing a paycheck deduction every 2 weeks, you see the actual contribution you're making to the healthcare plan.
He's the CEO of Oscar Health. He's also the former chairman and CEO of Aetna, among a lot of other different positions that he's held in the healthcare industry.
But probably the most important thing is that healthcare has now become very individualistic. I want it to be fit for me.
Does it mean that as an individual, if I'm really healthy and young, I can get a much better premium? But if I'm somebody who has a family and is using the healthcare system, I'm going to be paying a lot more?
So here's how you have to think about it. You have to think about the employer giving to employees what they've traditionally given them for benefits. Mm-hmm. It's defined contribution instead of defined benefit. You allow that employee with some assistance to understand what's going on in their use of healthcare to get them into the right plan.
Traditional healthcare plans see a 25% year-over-year increase in premiums. But with Oscar Health, their premiums remain flat year over year. They do not increase. I'm going to show you in a minute why they're able to do that. In addition, the premiums are lower than they are with traditional health insurance. Instead of an average of $375,000 per year, with Oscar Health, it's only $320,000 per year, which is a 15% savings. The benefits continue with employees. Rather than having only 3 plans to choose from on a traditional employer-sponsored health insurance, with Oscar, employees get 118 plans to choose from, and the costs are much lower on prescriptions as well. With traditional insurance, insulin costs are around $1,200 per year to the employee, and with Oscar, it's only $300 per year. The benefits that Oscar is able to provide are the reason why Oscar Health is growing so quickly. Through 2027, Oscar expects to grow revenue at 20% per year, and they also expect to achieve a 5% operating margin within the next 2 years. And I know a 5% operating margin isn't that high, but it's not that different from how Tesla was in 2019 when they were just starting to become profitable as well. Because of the savings Oscar Health was able to provide to both employers and employees, they have now accumulated 7% of the total market share, and they're still only operating in 18 states. At the rate Oscar Health is growing, they are going to exceed United Healthcare's market share. Look at the exponential growth that Oscar Health recognizes in each market they enter. In Miami, Iowa, and Atlanta, their growth was exponential, and that is how it is in every single area they enter. This chart is probably the most impressive one. On the gray line here, this is the average cost of medical care in the United States. And as you can see, it continues to increase year over year over year. But now look at the light blue line, and this is impressive. Oscar Health's cost of healthcare is actually going down, not up. And that is how Oscar Health is so profitable. Their costs are going down, even though their revenue is going up. And when revenue goes up and costs go down, profits increase. And how is Oscar Health able to accomplish all of this? It all has to do with their technology. Their aspiration is to build the most automated health plan with zero manual intervention, zero errors, and zero friction, using a brand new technology stack and AI, very similar to the way that Upstart revolutionized the loan industry. Oscar Health's technology also has incredible benefits for doctors' offices. Doctors are seeing a 118% increase in annual wellness visits. They are saving 600% by switching from 30-day refills to 90-day refills. They're seeing a 48% in year-over-year increase in appointments scheduled and a 13% increase in client retention. And that is why so many doctors are wanting to sign up with Oscar Health, which further is decreasing their costs. Not only is Oscar Health the most advanced technology company in the healthcare industry, they're also the fastest growing. Their proprietary technology platform enables Oscar to integrate new AI features into their operations faster than any other company in the market. As a result, over the past 2 years, they've seen a 40% reduction in administrative effort for messaging encounters and a 56% increase in provider satisfaction with their software. So that's what Oscar Health does, and that's how they do it. Let's take a look at the financials. To perform a good fundamental analysis on this company, I want to take a look at both their annual financials as well as their quarterly financials. On the annual financials, the most impressive thing is just how quickly they've grown their revenues. They've grown their revenues every single year, and they've grown them quickly. Operating income also increased to the point where they actually turned profitable last year for the first time in the company's history. Their earnings per share were at 10 cents, but more impressive is the fact that their normalized diluted earnings per share were at 8 cents for the year, meaning the vast majority of their profits came from their actual operations, not weird things like investments. On an annualized basis, this stock looks impressive, and I can certainly understand why Michael Burry bought it. But when we start digging into the quarterly side of the fundamentals, this is where the risk of this stock really starts to show up. Over the past 4 quarters, Oscar Health has not really increased revenues much at all. And most concerning is that last quarter, the revenues actually went down. Operating income also switched from highly profitable in the first 2 quarters of 2024 to losing money once again in the second 2 quarters of 2024. Profits also declined, going from 62 cents profit and 20 cents profit in the first 2 quarters to a loss of 22 cents and a loss of 62 cents per share in the second 2 quarters. This stock reminds me a lot of Tesla in 2019. In 2019, getting into 2020, Tesla was just starting to become profitable. They'd have one profitable quarter, and then they'd go back to losing money for a while. Then they'd have another profitable quarter, and then lose, and then another profitable quarter, and then lose. And it took a long time for Tesla stock to start gaining any kind of momentum. It wasn't really until Tesla stock was able to see multiple quarters in a row of profits did their stock absolutely take off and start skyrocketing. And as a result, while Tesla stock was kind of in the trenches in 2019 and 2020 and just kind of trading flat around that $4 to $5 range, that was the time to buy. That was the time to accumulate, because by 2021, the stock had run up to over $400 per share. And this is post-split prices, of course. So you have to accumulate while the risk is still high. But because we are talking about investing in a risky stock here, we've also got to put some good stop losses in places so we don't lose our shirts like people did on Teledoc. So let's take a look at some of the technical analysis and try to decide if now would be a good time to buy or if maybe we should wait. And let's talk about a few price points we're going to want to look at. When Oscar Health became profitable last year, the stock rallied from $2 a share up to around $15 per share. But now, over the past year, the stock has traded pretty much flat, right in this $15 range. And over the past few weeks, especially, the stock has been extremely range-bound between $13 and $17. Now, technically, whenever we see a stock in a range bound like this, we are looking for it to either break out to the downside and fall or break out to the upside and rally. Which way it goes, we don't know. We're just going to have to wait and see. We see another concern on this chart when we look at the daily chart. The daily chart has formed an M-shaped pattern, also known as a twin peaks. And this is bearish because it usually occurs after stock has rallied and then it finds some resistance at a certain level and then it starts falling once again, indicating that Oscar Health would fall. But the thing you have to understand about technical analysis is that it's only accurate about 60 to 70% of the time, meaning 30 to 40% of the time, the technical analysis is going to fail. And that is what we saw with Oscar Health. Rather than falling like the Twin Peaks pattern would indicate, Oscar Health actually traded flat, which makes the Twin Peaks pattern null and void and no longer bearish. With Oscar Health now finding strong support at this $13 level, this is the support level we need to watch to make sure the stock doesn't fall further. And this is also the level that we're probably going to want to put our stop losses at. So for me personally, as I consider buying this stock, I'm probably going to be looking at accumulating the stock somewhere around the current price range. I will probably set a stop loss a little bit below $13, probably around $12.50 or so. And I will be looking to load up on the stock if we get that breakout above $17. Of course, the technical analysis on the stock is going to change on a day-by-day basis, and that's why we've been talking about the stock on almost a daily basis in the Stock Dads Discord. Johnny Pools did his recent analysis and says he could see one big giant cup and handle forming, which would be very bullish on the stock if it plays out. We also do a lot of analysis on other stocks as well. One of the stocks we've been analyzing and making a ton of money off of is BABA, Alibaba. And the profits have been massive. Somebody made a more than 200% profit on an SPX call option last week. Another person made a 43% profit on Microsoft call options. And on Friday alone, somebody made more than a 300% profit on a QQQ put. And not only are the profits massive, they're also consistent. Most of our trades make money. One Stock Dads member who still holds a full-time job was able to make money every single day of the week by following our full-time professional multimillionaire traders and simply copying their trades. And if you want to potentially make profits like this in your portfolio also, make sure you check out the Stock Dads Discord using the first link in the description below.